Diego just signed papers putting himself another $200,000 into debt, and he did it grinning like he'd won something. His bank account didn't shrink, his net worth just went up. Meanwhile, 3 doors down, Curtis hasn't owed a soul $1 in 9 years, checks his perfect credit score like it's a lottery ticket, and is quietly, slowly going broke standing still. My name is Nick, and I've spent an embarrassing amount of my life studying why the guy cheerfully drowning in loans keeps pulling ahead of the debt-free guy who did everything right. Here's the part nobody says out loud. Diego didn't get rich in spite of the debt. He got rich because of it. He figured out something Curtis never will, that there are 2 completely different kinds of debt, and only one of them is quietly trying to ruin you. Today, I'm showing you the 6 ways regular people use the good kind to build serious wealth. Let's get into it. So let's clear something up before anybody in the comments loses their mind. When I say debt makes people rich, I'm not talking about your credit card. I'm not talking about the 28% interest you're paying on a couch you bought in 2022. That kind of debt is a wealth-eating parasite, and if you've got it, everything else in this video comes after you kill it. What I'm talking about is a completely different animal. Here's the cleanest way to see the difference. Bad debt buys things that lose value and drain your account every month. Good debt buys things that either climb in value or pay you to own them. That's the whole line. And here's the stat that flipped my assumptions when I first found it. You'd expect rich people to be drowning in debt, leveraged up to the eyeballs. It's the opposite. According to Federal Reserve data, the wealthiest households carry far less debt relative to what they own, around 12% for the top sliver, versus well over 60% for a typical middle-class family. The rich borrow less proportionally and get richer doing it. Because it was never about how much they borrowed, it was about what they aimed it at. Curtis never learned that distinction. He heard debt is bad once, probably from a guy on the radio, and built an entire identity around avoiding it. Diego heard the exact same advice and asked one better question. Which kind? Hold on to that question, because it ends up being worth roughly 8 times Curtis's net worth. So let's walk through exactly what Diego aimed his debt at, starting with the oldest leverage play in the book. The first way is real estate, and it's first for a reason. It's the most accessible serious leverage a normal person can actually get their hands on. Here's the trick. When Diego buys a rental, he doesn't pay for the whole thing, he puts 20% down and the bank covers the rest. But, and this is the part that breaks people's brains, he keeps 100% of the appreciation. Put numbers on it. The property costs $250,000. Diego puts down $50,000. It rises a modest 5% in a year, $12,500. If he'd paid all cash, that's a 5% return. Fine, boring, but he didn't pay cash. He put in $50,000, so $12,500 is a 25% return. Same house, same year, same market, he multiplied his return by 5 using the bank's money. And that's before the tenant shows up and starts paying down his mortgage every month with their own paycheck. Fast forward 10 years on that single property. It's worth around $340,000, the loan's down to about $166,000, and Diego's equity, his slice, is roughly $180,000. His original $50,000 turned into $180,000, largely on somebody else's income. If you've ever wondered why landlords always look a little too relaxed, that's the reason. Now the hard part, because leverage is a knife that cuts both directions and I don't want anyone emailing me from bankruptcy court. That same multiplier runs in reverse. If the house drops 20% instead of rising, Diego's entire $50,000 down payment is gone. Wiped, and that's not a hypothetical, it's a documentary, it's called 2008. When millions of over-leveraged owners watched their equity evaporate while the bank came knocking anyway. Leverage does not care about your feelings, but bought right and held through the rough patches, it's a machine. Diego can even refinance, pull his original $50,000 back out tax-free, a loan is an income, and run it again with the same money. Investors have a name for that loop. They call it buy, rehab, rent, refinance, repeat. Diego buys a beat-up place cheap, fixes it up until it's worth more, rents it out.